Okay, so again, notes payable, it's very similar to accounts payable, except a couple things. Number one, there's going to be some formal contract that is going to outline the terms of this agreement between the borrower, the debtor, and the creditor. Okay, so if we are having a note receivable, we are lenders. Okay, we are expecting to receive. We've like lent money, or we've provided services, or we've provided some goods to someone, and we're expecting to receive money later. Okay, so so in the case of notes payable or notes receivable, again, it's symmetrical, right? If there's a notes receivable, there's also going to be a notes payable on the balance sheet of the borrower. Okay, but again, this chapter is about receivables, so we're assuming that we are the lenders. Okay, so some terminology, principal. This is the amount that is loaned. If it's the if you provided services, it's the value of the services that you've fronted. Okay, but it's going to be the amount that you've kind of lent to the borrower. There's going to be interest. Okay, interest is basically it's like a rent. Okay, whenever you use someone's house and live in it, you're paying them for the kind of the right to kind of use their stuff, right? It's the same thing with using people's money. If you use someone's money to buy a car or buy a house, you're going to pay them for whatever amount of money is still being borrowed, right? And you're going to not only pay them that rent, quote unquote rent for that amount you borrowed, you're also going to at some point pay them back that money. Okay, so interest and principal are two separate things. The principal, again, is how much you've actually borrowed, and the interest is the rent that you're being charged for the right to kind of have borrowed that whatever you're borrowing. Okay, um, it's usually expressed as a percentage. I think we all have probably seen interest rates being expressed, and it's usually stated per year. So if it's 8% per year, to get a per day interest, we just divide it by 365, and so we can get a per day interest rate. Maturity date, okay, this is when the final payment of a loan is due. So a lot of like when you borrow a mortgage, like when you buy a house and get a mortgage, the maturity date is actually not that special because a residential mortgage is set up such that each payment is exactly the same amount every month, and it includes interest plus some amount of principal, so that by the end of the 30 years or 15 years, the principal balance is zero. Okay, so every month you're paying off the interest plus some amount of the balance that you borrowed, and the math is perfect such that on the last payment date, the last payment is just going to bring your principal balance to zero. Okay, and we're going to see that in chapter 12. We'll do like a table, and we'll see how a mortgage uh, amortization table looks, and you'll see that every month your balance on your mortgage goes down, goes down, goes down, goes down, and by the end of the 30 years, it will be exactly zero. Okay, and the payment amount per month is exactly the same. It's not a trivial math problem to figure out how much that payment should be. And there's a function in Excel that does it automatically, but we'll kind of see that in chapter 12. Some loans, you're only going to pay interest and no principal, such that on the maturity date, you have to pay back this big lump sum of whenever you borrowed. Okay, I think we watched a video on General Growth Partners, that real estate company that had those big maturities, and they could not find a new lender to help them pay off those loans that came due, and that was a problem for them. Okay, so most commercial loans have big payments at the end because they don't get, most banks will not lend for like 30 years to a business. Okay, they're usually going to be shorter term, 5 to 10 years, and it's hard to pay off a large principal balance in 5 years. Payment per month is going to be too big. So there's typically going to be a large balloon payment on the maturity date. So in that case, the maturity date is actually really important. Okay, because at that on that last date, you're going to have a really big payment. So maybe you're paying $1,000 a month, but on that maturity date, if it's a commercial loan, it's going to be $1 million, something big. Okay, so you have to come up with that money somehow. Okay, and then there's a payment schedule. So this is like for loans, for bonds, there's a fixed payment schedule. Every month, you can plan out every payment for the entirety of the loan. Okay, if assuming a certain, assuming that it's a fixed rate, fixed interest rate. Some loans have floating interest rates that change over time. But if it's a fixed rate, fixed interest rate loan, you can plot, and the maturity date, how long, what the term of the loan is, as they say. You can have an exact calendar of how much every payment is for the whole life of the loan. Okay, and that calendar and that tabulation is called a payment schedule. Okay, so this is an example of a promissory note. This is actually a loan that I, in my business life, bought at an auction. Okay, the bank wanted to sell this loan, and they put it up for auction. So what they're selling is essentially this contract. This is what I bought. Okay, it's a mortgage that's secured to a commercial property in Fremont. Okay, so what does it say? It says the loan date was 2005. The principal balance is 127,000, and it was a 25-year loan because the maturity date is 2030. Okay, and then it's gonna list all the terms. So it has the payment information here, and this is all in legalese. Really, uh, lawyers and for whatever reason they make it just so obscure and like difficult to get the relevant information. But it's basically saying, the interest rate. It was a floating rate loan. So it's saying how is that new interest rate calculated? How often is it calculated? So it's saying, if you read in here, it's using uh, prime plus, let's see, where is the spread? A margin of 1%. The prime rate published in the money rate section of the West Coast edition of the Wall Street Journal. Okay, so when I wanted to recalculate what the new interest rate is, I have to find the West edition of the Wall Street Journal on the date of when the interest rate resets and see what that prime rate is, and then add 1%. And that's the new interest rate. Okay, so all this is specified in this agreement. There's prepayment penalty, meaning if he pays the loan off early, what happens? If he makes a payment late, what happens? So all these different terms are spelled out in this agreement. Okay, this is like kind of what a promissory note looks like. It's also going to say what this loan is secured by. So he basically pledged his property to guarantee the principal of this loan. So if he stopped paying, then whoever, the bank initially, but then they sold the loan to me, I could then foreclose and kind of collect the money through selling his property at an auction. Okay, and he's signed over that right when he took this loan. Okay, so it's all spelled out here. And of course, signs it. This is the most important part, actually. If he didn't sign it, then this contract is not valid. Okay, so I just made, me and Gemini came up with like what were the main terms. So that whatever 5-page legalese document. What are the relevant things, right? I just had ChatGPT read it and summarize. So the borrower, I just kind of changed his name. The lender was Zion's First National Bank. Okay, they're the ones that initially gave him the loan. I bought the loan from Zion. Okay, they for whatever, I think he was in default. He had stopped paying, and they just didn't want to deal with it, so they were selling it. Okay, um, I of course did not pay the outstanding balance. I bought it at a discount. Right, that was the incentive for me to kind of take on a loan that's not paying. Okay, so they were willing to part with it and just get the cash. They didn't want to deal with anything else. Okay, so that was my incentive, was to deal with this guy. And actually, the guy turned out to actually sell the property and pay off the full amount of the loan. So it was a good deal. So yeah, so the interest rate is initially this, but it's going to be it's variable. It changes um, quarterly, right? So every 4 times a year, the interest rate is going to vary. It could go up, it could go down. Um, and then there's a payment schedule. So for the first 10 years is one thing, and then the next 10 years or 15 years is something else. And it was fully amortizing because you can see on the last day is just going to be some payment. So it was a fully amortizing loan. Okay, so essentially, I just wanted to show you in a real. This is like a real world, like this stuff actually gets incorporated into real legal documents for notes payable. Yeah, so then I would have had to hire a company that basically is a third party because I don't own the property. I'm just the lender. But the terms of the loan and the security that he's kind of signed over allows this third party to conduct an auction. Okay, so that third party would do all the filings, kind of public notice to say, hey, this property is going up for auction. The sale would happen. If no one bought it at the auction, I would then own the property, and then I could sell it.